In your investments, you need to avoid the higher cost mutual funds. Investing in some mutual funds is like buying a $3 candy bar and paying $5 for shipping and handling. All mutual funds are not created equal. You can boost your returns simply by doing a little homework before writing a check to a mutual fund salesman. The most important thing to look for is sales charges. Mutual funds that carry a sales charge are called loaded funds. We never invest in loaded funds. There are three kinds of loaded funds, and they're each designated by a letter. A shares are front-loaded funds. They charge a fee every time you buy them, and it's between 4 and 6%. So it's like losing an immediate 4 to 6% on your investment. B shares are backloaded. They don't have any front-end charge, but if you try to sell them, they charge a redemption fee. And that redemption fee can last up to 7 years. And while you hold those investments in the B shares, they're charging significantly higher other fees. So it's like they're holding you hostage, and if you try to get out, they're going to gouge you on the way out. C shares are called level loaded. They have no front end or back end, but their yearly fees are very, very expensive. For them to be called no load would be against the law. Avoid all loaded funds, A shares, B shares, and C shares, and buy only no load funds. Another fee that can be put on mutual funds is called the 12b-1 fee. It's named for the Securities and Exchange Commission rule that originated it. A 12b-1 fee permits a fund to pay for some or all of the costs of distributing its shares to the public. In other words, they're charging you because they're advertising the fund. While you own their fund, they're deducting the cost of advertising from the fund's investments. The more they spend on advertising, the lower your investment return. If you do have a fund, it should have a 12b-1 fee of no more than 0.25%. It's better to invest in funds that have no 12b-1 fee. The final expense on a mutual fund is called the expense ratio. All mutual funds, regardless of whether they're loaded, no load, or have a 12b-1 fee, do have management fees and operating expenses. Look for a fund with a low management fee. What constitutes low depends on the type of fund. A management fee of 0.5% is low, but some fees have management expense ratios that are all the way down to 0.1%. Typically, management fees between 0.75% and 1% are typical. Anything under 1% is relatively good. Aggressive and specialty funds will often have higher management fees, maybe between 1 and 1.2%, and some mutual funds will have exorbitant management fees, 2% or higher. The final expense that goes into a mutual fund is called turnover. A mutual fund is constantly buying and selling stocks, and when it's buying and selling stocks, that has an expense to it as well that's often different from the management of the fund. Turnover is a measurement of how much they're buying and selling and how frequently they're changing their holdings. Turnover is measured by the percentage of a portfolio holding that's bought or sold each year. A mutual fund with 50% turnover changes half of its security holdings every year. Mutual fund turnover is generally bad. High turnover funds generate lower returns on average than low turnover funds. These four factors can provide a large financial drag on your investments, and choosing mutual funds with higher costs means your investments must gain an extra few percent just to overcome the expenses. If you rely on a commission-based financial product salesperson, you will probably be sold the wrong kind of fund. You can avoid these expenses by doing the research and purchasing no-load and low expense ratio funds, or you can seek the advice of a fee-only financial planner. Fee-only financial planners do not receive any commissions, and therefore they have the incentive to only act in your best interest. In fact, they are required by law to act in your best interest.